morning, everyone. Welcome to a new month, 1st of August today, MPC Markets Morning Call. And despite yesterday's absolutely stunning and outstanding results from Meta and Microsoft, which saw the stocks head significantly higher overnight, investors sort of started to leave the party a little bit. We really did have, sentiment was quite dour, and it's probably the first time in a long while I've seen the market really not basically make a positive out of just about anything, really. And we had two really massive positives to focus on because, the Microsoft and Meta yesterday were simply outstanding overall. For me, it's actually really caused a bit of a mental re-rate for Microsoft. In my head, I had them a little bit more on the conservative side of the growth sort of spectrum for the Mag 7, and I think they got their mojo back. A little bit disappointing overall, but it is the way it is because we do have these Trump deadlines looming. So we're 6 hours away currently. It's around about 8 o'clock in the morning here, Sydney time in Australia. Trump did ring the Mexican president and offer a 90-day reprieve. And then but despite the fact all day he's been saying it's a hard deadline, it's a hard deadline, it's a hard deadline. So not, as per usual, who knows what's going on in that guy's mind. I don't think he necessarily even knows what's going on. It'll be interesting to see what happens over the weekend, and I cannot see today being a good one for the ASX, nor probably the US market tonight, leading on Friday night here, just due to the fact that 48 hours in the world of President Trump, with a hard deadline in inverted commas, coming up. Look, it's going to be hard to keep up with. So I think there'll be, I'm probably half a dozen, I reckon, threats will be over the course of the weekend, if not a dozen. So I can't see investors being in a risk-on mindset leading into tonight. We've also got US payrolls, which is US employment data tonight as well. Quick one here on the commodities. Obviously, copper, that move was on the back of the adjustment or the watering down of that copper tariff announcement yesterday. We covered that in yesterday's podcast if you want to go back and have a look at that. Silver's drifted off as well. It's been more about, I think people were drifting towards store of value assets and drifting away from the US dollar. And because Trump's chickening out, or Taco, Trump always chickens out, and it's really coming back to more like that 10 or 15% mark on a lot of these deals, if there's deals done at all. The need to be exiting the US dollar at with some urgency has probably been alleviated a touch. So silver's had a pretty horrible week, really, down 6 and a bit percent. Pales into comparison to copper, obviously down nearly 25 there. Platinum also down 10%. So, and that they're also risk measures of risk on and risk off sentiment. So when silver and platinum are getting hit, that is usually correlated with investor risk sentiment. Not always, but very often there is quite a strong correlation there. So lithium as well, down 11.6 for that ETF for the week. And so some of those moves are quite significant. It's just that you've obviously got that massive bar there with copper down nearly 24. I think personally, we had broadly lightened here at MPC, and our only copper exposure is really in BHP. The house view, and I personally think that silver and copper particularly these are fantastic buying opportunities in the medium to long term overall, because all of this uncertainty and tension between the US central bank, the Federal Reserve, and the president, and the trade deals, and there's uncertainty's not uncertainty is not leaving the building for the next few months, and we're coming into some seasonal weakness, and we'll start to see a little bit of that flight to safety or return to real assets if the US market does peel back a little bit. So ASX did pretty well yesterday, mainly held up by most of the interest rate sensitive sort of sectors, although retail trade came out at 1.2%, expected at 0.3%, which really blows a massive hole through the whole rate cut argument. And apologies for yesterday. We had so much on yesterday. I missed the advanced GDP numbers in the US, which were 3%, expected at or low twos or 2.4, I believe. That's a massive beat as well. So really strong economic numbers. So this you've got to see the forest for the trees here, people. Like the media and the pundits. It's very popular to say, "Give us rate cuts, give us rate cuts," and that's how you sell newspapers. But the reality is, and that's why the central bank is independent, they have to make the responsible decision. They've got to be the adult in the room. We don't need rate cuts. We got asset prices at record highs, housing prices in Australia at record highs, 4% unemployment, and by any historical measure, fairly robust metrics for both economies. This is not an environment pre the GFC where we went to emergency rates and now everyone thinks that's the new norm. Pre that 2008 era, I guarantee you we would be talking about rate hikes, not rate cuts. And we, in the long term, we do probably need to wean ourselves off this addiction to low interest rates and basically buying votes because asset prices keep rising and the unemployment rate's really, really low. So because it causes systemic problems in the economy in the long run. But this is a much longer conversation. But Asia drifted off yesterday. The Dow being down and the NASDAQ being down, there's no way in the world I would have picked that overnight. Microsoft and Meta were really the only shining lights here. Meta was up 11, Microsoft up 4. Amazon was up 1.7 leading into its earnings because everyone assumed, well, Azure for Microsoft went well, Amazon's going to knock it out of the park. And I did pre-warn everyone yesterday, sometimes it can be a case of Microsoft eating AWS's lunch, and that seems, despite the fact that Amazon beat on both top and bottom lines, revenue and EPS, currently down 7%, and the market was very disappointed. So it's a bit of a case of Microsoft really probably pushed the sentiment towards Amazon before the number came out, and those broker expectations or Wall Street expectations were probably they're a little bit dated in terms of, and investors were expecting more. Apple absolutely smashed their expectations, but look, that's where Wall Street set it, whether or not. But I don't like using hyperbolic descriptions of it because I'm pretty sort of negative on that company, and what I went through with the transcript for the earnings, etc., was more so how much they were mentioning AI and what they actually focused on, and what they focused on was iPhone. So sales for the iPhone weren't as bad, basically, and the tariff effect wasn't as bad. But as you can see here, like services, so these services really come off the back of this hardware, right? So if this iPhone drops, if these iPhone sales drop, this will dramatically affect this revenue line as well. And these two revenue lines are, as you can see, significantly the largest revenue lines for the company. They are sitting on an absolute bucket load of cash, but there was just very little. Look at their R&D's tiny compared to their net profits. and considering they're going to get that tax break with the big beautiful bill, that's sort of disappointing. There's been no announcements. They danced around the AI thing, saying Apple Intelligence is coming, but it's clearly not their focus because they basically avoided the subject based on the transcript and talked about iPhone, which, apart from a new processor and an improved camera, hasn't done anything since Barack Obama went into power or George W. Bush left power back, early 2010s. So I really question management in the. I mean, look, it's a great product. It is a cash cow. Don't get me wrong, but if they do not start to parlay this, that major win and that huge cash pile into buying some AI wins, they're. I think they're just a real risk of becoming irrelevant over the course of the next decade. It's not going to. It'll be a slow burn, and by the time they realise, it'll be too late to pivot. And so I think they need to get aggressive with their cash. You're sitting on hundreds of billions of dollars worth of cash. I think the Apple is sort of at the stage where they've got to stop being lazy and they're just going to have to start buying some wins, like Meta's done, like Microsoft. I mean, Microsoft's earnings yesterday, they paid up for OpenAI. They've got a fairly poor deal, but they got first mover advantage there, and it came through in their earnings in absolute spades yesterday. So they've entrenched themselves with well over 80% of the Fortune 500 companies, and entrenched themselves in the AI thematic overall and bet big on it, and it paid off, and it's paid off very quickly. So yeah, as I say, you got to question their choices overall. Now Amazon as well. This is quite an interesting one because everyone sort of assumes that online stores. Well, Amazon is just the online stores. So, but as you can sort of see here, AWS is pretty significant, which is their web services or their cloud services. It's a really significant part of their revenue, and it's up 17% year on year. But if you have a look over here, I mean, the rest of the revenue, we're talking it's at 67, so about 130 billion. Versus AWS is 30 billion. But if you look at the profits, the operating profits, AWS actually makes more than all of the other revenue lines combined. And there's a lot of operating expenses, etc., in there. So they are the sleeping giant of the cloud and data center services arena, and major competitor being Microsoft, and I think more so it's Meta's got all the data via Facebook, etc. Microsoft's got it through Office. These guys, I think they get Google's got it through the search engine. These guys have obviously got it through your spending patterns, etc. as well, and they do sell a fair bit of advertising, and so that. I think that online store part's not necessarily the focus, but it is extraordinarily useful in collating data about consumers and customers. But I mean, look, and look, I know I was really harsh on Apple, but as you can see there, the net profit part is a lot bigger. It's pretty thin net profits there for Amazon overall. So yeah, it's different styles of business. So you can kind of see why people are attracted to Apple. It's simple. But if you're looking in terms of growth, I find the company really disappointing overall. So ASX today, we have ResMed, I believe, delivering some earnings. But I think the session will be very much a risk-off session. We've had commodities drift off. The Nasdaq surprisingly has, despite some stellar efforts from Microsoft and Meta, has drifted off as well. That payrolls number tonight is super important. We haven't really had the numbers are a little bit jinky at the moment. I can't really. They don't seem to be a true reflection of what's sort of going on in the economy, but I would expect they're expecting about 106,000, which is low. Normally we average 120 plus expectations, and look, I wouldn't be surprised to see a weak number, but I've said that a number of times before, and it just seems to surprise to the upside continuously. There is some manufacturing data, ISM manufacturing coming out of the US as well, which could be quite important. On the economic front, overnight, there was slightly weakening numbers in employment. But look, I think the big show realistically is what is Trump going to do and say over the weekend. And, you know, my money on the line, I'm certainly I'm approaching today with a very risk off attitude, and just wait and see, because as we saw in April, having that cash, that high cash balance, particularly as we've bounced, this is the basically the best rally in history out of a bear market, and the steepest. I think you'd be mad not to be taking some profits up here, and as it stands at the moment, because when we bought quite well in April, we were a high cash balance. It's pretty much set up our year now. We can afford to be patient. So it'd be I think that is probably the best approach, at least for the next week or two. And August and September obviously bring in that seasonal weakness as well, as we've discussed in previous in the previous morning calls. So yeah, it's been an extraordinary run. The best way to look at it, I suppose, is get yourself a chart of this year, and just realise in the context how lucky the market is to have got this rally, and I think we'll start to see investors realise that this is a pretty good opportunity to be banking some profits, and maybe settle down for a little bit, and try to see the forest for the trees, because I think those big Microsoft and Meta earnings, or those big Mag 7 earnings, they're stealing the headlines, and Trump's stealing the headlines, sort of disguising a fair bit of broader market weakness overall. So yeah, sorry to be a little bit dour, but sometimes you've also got to take, you've got to be a little bit more conservative, because what people don't realise is the value of that cash at lows, when you can buy high quality stocks instead of scrambling because you're over allocated, is just worth its absolute weight in gold. So it's certainly something we focus on here at MPC. Bulls versus Bears podcast will be this afternoon. We will release that tomorrow, well, this evening or tomorrow morning, with Jonathan Takadena. If you haven't checked that out, check that out. And have a great day, have a great weekend, and we will talk again Monday morning.
General advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional.